Hard money lending. What does it mean? How do you calculate your interest payments? And what do points mean? I know when I first got started in real estate, these were questions that I wanted to know answer. I just wanted one video, one place that I can get all these things answered. And so in today's video, I'm going to try to simplify that process and show you all how to calculate your interest payments, how to calculate points, and the different interest rates that are going out, that are being offered right now in the marketplace, especially during this time when rates in the more traditional route are already high. And I'm also going to talk about how you can use hard money lending in wholesaling and other areas of real estate. I'm going to show you all a real quote from a hard money lender that I'm using for a flip project, and just show you all just the different aspects of this side of business that's very important for anybody in real estate. So if you all have any questions, let me know down below, like this video and subscribe. So the first thing that I want to talk about right now is just showing you all an example. So this property, let's say you're buying a property for $50,000, you're going to put $50,000 into rehab. Now down payment. Most hard money lenders require a down payment requirement, right? And it may be 10%, maybe 20%, but that percentage is based off of how much your loan to value is. So for example, let's say this property, you're going to put a total of $100,000 in, right? Your ARV is $150,000. And so if you take, for example, $150,000 and you multiply it by 75%, you're going to get $112,500. So that's lower than your total amount that you want from your lender. And so they'll be able to fully fund this purchase for you. But let's say the ARV is $130,000. Now, this changes the dynamic because now it's less than $150,000, less than $100,000, or less than that 75%, right, loan to value, because you need $100,000, but your lender is only offering 75% loan to value, right? So that's where your down payment requirement changes to from 10% to 12.5%, because you're going to need to bring an extra $2,500 to the closing table in order for your lender to finance this deal. Now, every lender is different. This may be 85% loan to value, and that gives you a little bit more room to play with and things of that nature. But during this time, I think most lenders are just operating on the 75% loan to value rule. Some lenders may even be a little bit lower. So that's something that you have to look out for. Now, on your quote with hard money lenders, they usually have interest rates and points. Now, interest rates are based off of the purchase price less your down payment. All right, you hearing me out? Purchase price less your down payment. And then as the months go on, as you take from your rehab budget, they add that to that principal amount, and that's your interest payment. And we're going to show you all examples of that. Now, your points is an upfront fee that you have to pay your lender upfront before anything happens. And this is based off of your purchase price plus your rehab minus your down payment. So, for example, this would be $90,000 times its 2.5%, and that's going to be your payment. So, if we just do $90,000 and we multiply it by that 2.5%, that's the amount you have to pay at the closing table upfront. Now, this is just a fee a lender charges because they're taking more risk with you because you're flipping a property, right? Some lenders don't even require you to have a specific credit. Some of them don't require a certain income level, right? And so they're taking more risk because your property needs to be flipped. It's probably not livable. And so interest rates are higher, right? And so they charge these points in order for them to actually make some sort of money from this deal. The other thing that I want to talk about are reserves. So a lot of hard money lenders require a minimum reserve. The one I'm dealing with requires a 25% reserve based off of the purchase rehab, right? Plus your down payment. So for example, you need a total of $100,000, right, for this loan. they're going to require $25,000, which is 25% of the total loan plus your down payment. So in your bank account, they need to see at least $25,000 in your bank account, because they know obviously you're going to bring this $10,000 to it, and so they're going to require $35,000, around $35,000 sometimes. And sometimes it may not even include the down payment, and they just look at the $25,000. So it depends on each hard money lender. So that's points. I hope that makes sense, because I was confused about points when I was first learning the hard money lending business. But that's that. Now, your monthly interest payments, how's that calculated? So let's say month one, you're not going to rehab the property. Let's say you're just letting it sit vacant for right now. Maybe your contractor is delayed, or your contractor just puts you in line and say, hey, I can work on it this month, but you still need to close on the property a month ahead. You don't draw from that, okay? You don't touch your rehab budget. So what's going to happen is they're going to charge you the $40,000, because the purchase price is going to be essentially $40,000 because you're putting a down payment of $10,000. So I'm going to put $40,000 here, and then I'm going to multiply that by your interest rate. Now your interest rate is annualized, so you have to divide that by 12 months in a year. So I just put the 1% here. And so your first monthly interest payment is going to be $400, right? And remember, it's based off of the $40,000 because you already put $10,000 down. Now these are interest only payments. So this doesn't go towards the principal amount. This doesn't go towards this $40,000 that you have, right? Does that make sense? Let me know down below. And then let's say you take $20,000 the second month, okay? And a lot of hard money lenders, the way they operate is that this is why they require a reserve. Let's say the second month you do the flooring, you do the kitchen, and that's $10,000. You out of your own pocket have to pay that. And then you need to show them proof that this work has been done and that you paid it. You have the receipt. Then they will reimburse you $10,000, right? Because when I first started to learn about this, especially with flipping, I thought, okay, well, hey, I need flooring. I need this done. Can you send me $10,000? No. They want you to pay out of pocket first, and then they pay you back, right? That's why you want to eventually go to private money, because with private money, it's specialized. You can make it however you want. You can be like, hey, I need $10,000 upfront to pay my contractor. Hey, we're about to work on this. Hey, the flooring has just been done. I need $10,000 to get it paid, instead of you coming out of pocket for anything. But anyways, maybe there are some hard money lenders, if you create a good relationship, if you've done a ton of flips with them, that you can do that type of relationship with them. But especially in the beginning, in your first couple of deals, it will most likely operate like that. So let's say you take $20,000 for the second month. You've done a ton of work the second month. So let's just put $20,000 right here. Now this $20,000 is added to this $40,000. And so now the amount that's getting charged by the interest rate is $60,000. And so your second month is going to be $60,000 times that 1%. And so in the second month, you're spending $600 on interest. And in the third month, let's say you finish this rehab, that's $30,000, $30,000 plus $40,000. No. Well, and plus the $20,000 that you already used. So it's going to be $90,000, right? Because you use all this rehab budget and plus the purchase price that you're borrowing from them, right? And so this is going to equal $90,000 times, of course, that 1%. Now $900. So total monthly, this is your interest payment amount. And so if we calculate hard money costs, what we can do is we can take the sum of this, right? Take that, equal that, and then what I'm going to add right here, I'm going to add this points. And so your total hard money cost for this loan within 3 months is around $41.50, right? That's just the cost of doing business, right? And so let's say you do sell this property for $150,000, right? What you're going to do now, you're going to subtract your purchase, your rehab, and then this hard money cost of 4150. But you have closing costs. Let's say closing cost is another 6-7% more, right? That may be $9,000 extra, right? So 9,000 plus 4,100, what is that? 13,000. You're still making a good amount, over 35 grand on this flip, but that's something that you have to consider when you're flipping properties. And so hope that clarified things on hard money costs. Now let's look at an actual quote from a hard money lender. So this is a hard money lender quote that I got. I blacked out the company's name, the address, but this is how it looks initially. This 12.5% interest rate, and these are their going rates right now. They're between 11 and 14 points, anywhere from 2 to 5%. And yeah, and then it had the monthly payment. This is my purchase price and my origination amount. This origination amount, of course, is based off of this $60,000 less my down payment. My down payment is $12,000 because I put $60,000 worth of rehab, right? So $120,000 total. So my down payment is $12,000. All right. So now the amount that I'm actually getting a loan off of is $48,000 because the $12,000 is coming off of the $60,000, right? So $48,000 plus that $60,000. Multiply that by the origination, that's $2,700. Hope that makes sense. And then they have the max monthly payment, like, hey, you're not going to make more, you're not going to get charged more than this, right? Things of that nature, just so you can have things of that and stuff like that. And so they had, cash needed to close. It says 15,880.83. That's the origination plus the down payment plus the prepaid interest that you're going to start paying. And then they usually have property coverage that sometimes your lender provides, and you just have to pay that up front. And yeah, this is an exact quote. Now, the other thing is, how do you use this for wholesaling? Let's say you have a big assignment fee coming up. What you can close on this property with a hard money lender and sell it later. Or let's say you do want to just do a quick flip where you just clean out the property, right? You can use a hard money lender for that, right? A lot of hard money lenders provide transactional coordinating, right? Transactional funding, where they give you money to close on a property, and then 1 or 2 days later, you sell it to your end buyer, right? And so that's where you can use hard money lending in wholesaling real estate. If you all have any other questions, I hope I clarified a lot on how to, process this and the different things a hard money lender requires. Please let me know down below. I know I talked a lot of numbers are flying out of my mouth, but I hope it made sense. Make sure you all like, comment down below, and subscribe. Talk to you all later.